hour with Riz and Riz from our team, and we're going to take you through some of the basics around like what you should be considering in your business from a numbers perspective. And often we sort of hear from our clients and people we talk to that that they might not identify as being numbers people, but that's totally fine. You don't need to you don't need to be accountants, and that's not what we're training you to become. But we want to teach you the sort of basics around financial stuff and numbers, so that you're able to run your business more effectively, more sort of what's the word, you're sort of looking at things before you make key business decisions, so that you know what the effect might be on your numbers. So we've got a bit of an action-packed hour with you. Looking forward to running through this stuff. I've just got a couple of things before we actually get quite into our subject today. We do have another webinar coming up towards the end of June. So our next one is on Friday the 25th, and this is all about funding business acquisitions. So we've got a finance whiz, Zach Goodman. He doesn't do like home loans or like sort of basic residential finance. His specialty is actually funding business acquisitions. So if you're considering purchasing a business in the next, whatever, or just want to know a little bit more about the topic, then please register for that webinar. Rose has actually popped that in the chat box for you now if you need the link to that. Even if it's a little purchase, like a little 100 grand, 200 grand business purchase, or you're looking at a couple of $1 million of who knows what, we get all sorts of different business types here. But yeah, if you are considering an acquisition, please come along to that. And even on the sale end as well, like if you're looking to sell down your business, over the next few years, I think it'd be great to see what a purchaser might look for when it comes to, even the banks might look for when it comes to helping your buyer fund a purchase. So that'd be great. I've known Zach for a couple of years now, and he's done quite a few really cool things with clients. A couple of other things. If you're not able to make it right to the end of today's webinar, what we've actually got is for people who want a little bit more either one-to-one stuff or want to spend some time in a workshop talking about these numbery things, we're actually putting together a couple of things. So the first one is we'll have 3-hour workshops in July that we're going to be launching. We'll be doing one in Brisbane, lockdown permitting. We'll also do one in Sydney as well. So we're working to set dates on the Sydney workshop soon, and we will have an online for people who can't make it in person or who aren't in Brisbane or Sydney. So if you are interested in knowing more or hearing about the dates of those workshops coming up, then Rose has posted an expression of interest form, and what are you interested in? If you tick the box that says workshop in July. The other thing that you might want to do, and we've had a couple of clients do this so far, and maybe more of a client thing initially, but happy to have a chat if you're not yet a client, is a one-to-one. So we've actually done a total financial control implementation. So basically taking what we're talking about in today's webinar and walking you through how to apply it in your own business and setting that up, setting budgets up. And we'll go through some stuff towards the end. But if you can't make it right to the end, then feel free to keep that in mind if you do want the extra hand. Wonderful. All right, looping right back to your numbers and not having to be an accountant to just understand enough. And I think the other thing is, like, if you think like business is a pretty hectic thing, right? You've got competition, there's risks from internal factors, there's risks from external factors, which we've seen, especially in the last 12 months. But what sort of edge can you get in your business? Now, I reckon more than 90% of the people we work with would identify themselves as non-numbers people. And let's have a think about if you can get an edge on a competitor. One of those edges might actually be knowing a bit about numbers and being able to trump the next person in knowing enough to get ahead. And so what we're hoping to share is putting you in that sort of 5 or 10% of people who identify themselves as numbers people, maybe not accountants, but you know enough about numbers to really, really supercharge your business. And that's what we want to focus on here. So the 5 things we're going to cover this morning is a bit around the why, like why would we want to do that? And I kind of gave a few hints there. We'll have a look at bookkeeping. Now, people sort of class that as a low value function, but it's actually an extremely high impact function. If you, so we'll go through a bit more of that. Cash flow. So cash is the next one we'll cover, and some really simple things you can do to help better manage your cash. Planning and budgeting. So we'll go through some sort of quick tips that might help you out there, and also reporting. So, how often do you look at your books or look at your financial reports? What do you look at? What do you keep an eye out for? So we'll kind of walk through some ideas there. And no worries, Anthony. So I'm just keeping half an eye on the chat box. Good to have you here, mate. All right. So, Riz, we're going to get stuck into the why.
Yeah, I think it's the most important bit.
Fantastic. Now, to kick us off, we've actually got a poll. Why did you start your business? Now, we've kind of given you a couple of suggested ones there, which is maybe the most common we hear. I'm going to launch the poll now. But if your reason for starting your business is actually not in those top 3, then please, if you're choosing other, just type what it is in the chat box. I'd just love to sort of dive into this. Just to see what the impact, and you can choose more than one. So if you think actually you might fit in all 3 boxes and there's even a 4th reason, then please pop it in. Lisa, flexibility, thank you.
Cool. Yeah, we've got a few people leading a charge on enjoy what you do more.
Make a difference and leave a legacy. Love that.
Love that one too.
Travel flexibility, maybe not internationally at the moment, unfortunately. Enjoy more, but control more. It's awesome. All right. So we're going to keep that in the background. But yeah, Riz, did you want to walk us through maybe some of the key reasons you see working with your clients?
Yeah, definitely. And I guess the thing that people kind of get started with usually is it usually comes from a passion or somewhere where you know you can offer more value to the world than what you are already doing. And you want to take control and kind of tell your story in a different way. And business is one of the big tools. Now, some of the key things that I see, kind of metrics that we can kind of measure, is definitely it boils down to making more money, making more profit. So that's usually one of the options that we see our clients look through is as they start businesses. Obviously, you want to make more profit because profit means more income, more wealth, and that means options. Now, options is actually a privilege to have. If we work hard for it and we get those things, we get more time. And more hours. And what essentially that means is I've seen clients say, Riz, I want more profit so that I can have more time with my family. I have more time to do what I love, or more time to kind of, expand my craft or improve my craft, or more time to tell my story. So yeah, time is something that's finite that everyone's trying to chase as well. And I think business is one of the ways that can give you more time as well. I know it doesn't seem like it at times, but we want to remind ourselves why we started business. Now, more time, and if you do everything that you love and spend time with family and kind of live your true purpose, what kind of ends up is you become more happy. So yeah, happiness is a big thing. Everyone wants to be happy, and in the pursuit of happiness, we do a lot of things to get there. So one of the things is running a really good, strong, awesome profit business that gives you a lot of time, and ultimately will give you the happiness that you're looking for. So these are the metrics that we look for when it comes to business owners, in terms of how much profit are you making, how much time are you working in the business, and how happy are you generally. And we want to remember why we started the business in the first place. It's really, really important to connect to that, so that everything else makes sense. And when we really connect to the reason we start, you have unlimited energy to keep doing what you're doing. So yeah, really, really important step.
Yeah, Fantastic. And I think everyone should be able to see the results of that first poll that we did. And the clear winner there is enjoy what you do more, which is pretty exciting, actually. So 57% of people who voted tick that one there, which is cool. Followed by make more money, work less hours. And yeah, it's interesting that often we think we might get a bit more balance starting a business, but yeah, I think that's a bit of an interesting roller coaster of a journey itself, especially those first few years trying to get something off the ground. So, yeah. And then the irony, yes, exactly right, right, Kathy. But
and I guess
anyway.
that's why we want to take a bit of time. Just at the start here is just really connect on your why. Like everyone has a different why, as we can see in the poll, but really connect on why, because the busyness of business can take away from that. And you want to really reconnect with that.
Absolutely. Alrighty. And the other interesting thing I do want to touch on is the impact of business value. So I do want to share some basics of business value, because I think a lot of business owners, when they sort of start working, they might just focus on that profit, like how much they can extract from the business each year or earn from the business. But I think sometimes we often look past the bigger picture or what impact this might have on our overall family's wealth. So what I've kind of got on shared now is some basics of business value. Now, not every single business is valued like this. I'm going to say most of them are, though. So we work out initially what an adjusted profit figure is. And let's take, like, you might log into Xero or your accounting software and see a profit there. But we need to make sure that that profit is adjusted. If someone else owned the business, is that what they would end up with? So if you haven't taken a salary out to pay you for your hours worked, we've got to adjust for that. We've got to take money out off that profit. But if you run things like, your cars or some discretionary spending, like conferences or things that maybe a buyer wouldn't need to spend on, we can also add them back to your profit. So anyway, there's a few adjustments that we make when we're looking to value a business, but that's step one. Work out what your adjusted profit is, and we call that a bit of a funny name as accountants called Ebitda. Earnings before interest, tax, depreciation, and amortization. So a bit of a tongue twister there, but the English version is adjusted profit. And Jade, no, we can't hear your kids. There we go. All right. Thanks, Kathy. That is a good accounting joke. Put that one in the quiver. And then what we do with that adjusted profit is we times it by a business multiple. So a business multiple is basically a reflection of the business's risk. So the less the business's risk, the higher that multiple will be. The higher the risk, the lower the multiple and the less money you'll actually end up getting. So if you're in an industry that, might have a bit of a timeline that's ending soon, or, one of the ones that might be impacted or uncertain with COVID, then I would expect something like that. You'll actually have a lower multiple. But if you're in an industry that kind of survives this sort of turbulence, it's got a bit of a history behind it. You've got a solid team in place. You're less risk for a buyer. So you might actually have quite a higher multiple.
Yeah, and to add with that as well, it's kind of like how you run the business. If you have one big contractor and that contractor falls, that's you'd have a lower multiple because there's a higher risk. Similar to you as a person, as a technician working in a business, if you stepped away from the business, what does that look like? Will everything fall apart, or will it keep going and still earn that adjusted profit that we see before? So there's a few things in there that's bundled into a business multiple. But yeah, it is basically the risk of the business in all aspects.
Yeah, and that's it. It's definitely qualitative risk assessment. And Mike Wells, for instance, has asked, does high competition equal high risk? I would suggest maybe. It just depends on is that normal in your industry? What are your normal industry benchmarks for sort of competition? Lower barriers to entry in an industry means that someone might actually be better off starting a business than buying yours. So you kind of got to look at that sort of stuff. But that's just one element of what we look at when we value a business. There's what's your vision, what's your team structure look like? As Riz said, what's your client structure? We're even in the a lot of the RTOs, I don't know, 4 or 5 years ago, 6 years ago, maybe now, the laws changed around RTOs and how they get paid by the government. So really their client was the government. They changed their laws, and then you saw so many RTOs get wiped out. Huge damage there. So yeah, that's an example of high risk. So cool. Now, I guess a question I'll throw out there is, do you know yours? Do you know your adjusted profit roughly, that Ebitda word, your business multiple, and that can change as well. That often changes depending on so many different risk factors. And then the question is, but how do we increase that? So if we increase our profit, we're increasing the money we take out of it. If we're doing things to reduce our risk, and make life easier as the person running the business, because we're trying to make it easier for a person buying the business, then our business multiple will increase, or should increase, and then our business value will also increase. And so these things are really all intertwined. And I guess the point I'm trying to make is it's interesting that you make more money, you work less hours in the business, or by force, you're forced to work less hours, is maybe another way to put it. You can choose to work more, but and then you increase your happiness through less risk and stress. Then I'll put a bet on that's actually going to make your business value go through the roof, and that's the sort of intergenerational wealth we see created. Yes, property is one of the biggest ways we see, but the one that just changes the game for families in general is a successful exit, or increasing their business value, because we see that actually can be increased so fast.
And like, kind of to flip it on its head a little bit, it's an equal, so one equals the other. So which one you have control on, sometimes day to day it does change, but you can see that increasing your business value, that also means that you get higher profits, work less hours, and ultimately more happiness as well. So when that question, do you know your business value? Yes, there's an accounting number that we can kind of spit out what your business value is, but by this equation, technically, you innately understand what your business value is. If all this stuff on the left-hand side is low, high with more hours, and you're not happy, that correlates to your business value. So innately, you might feel that if you feel your business is kind of taking away more from you than giving you the happiness that you're looking for, then there's definitely something in there that we need to look at fixing. And that's all what we're going to talk about today.
Cool. Awesome. All right. So we've covered the why. That was kind of our first step there. Now we're actually going to cover a little bit of an unsexy kind of topic, which is all about bookkeeping. P.S. Cheers you for registering for a webinar about numbers. That really isn't sexy on itself, but yeah, have a look at bookkeeping. So I mentioned earlier that bookkeeping is often perceived as a pretty low value task, but I would argue that it's actually one of your most critical functions in a business, because if you imagine you're driving a car, and you're driving it along, it hasn't had a wash in a while, like your windscreen's not too bad, and then a bird craps on your windscreen, and you can't really see too clearly through that. You go to turn the windscreen wipers on with the with water, but there's no water left, and so then you end up spreading this all over the windscreen. Like to me, that's like having bad bookkeeping. You can't see clearly out your windscreen. You don't know how to make decisions, or know where to steer left or right, or slow or fast, because you can't see stuff. That's kind of
it's like imagine if I took away your the fuel gauge, man. You wouldn't know how far you could go, could you?
That's right. You'd be a bit nervous trying to top up the car. Sorry, Kathy's asked a question. Is that in any way related to seagull managers? Probably you could use a similar analogy, but yeah, this one's the clarity in bookkeeping. So I guess another sort of point to sort of get across is with bookkeeping. let's have a look at the human body. So if we put like bad food, fast food into our bodies all the time, then the outcome is actually going to be like headaches and just feeling lethargic and maybe not exercising and things like that. It's actually not going to be a great outcome, is what we usually see with that, compared to getting all those vitamins and minerals in. The body processes that, loves it, thrives off it, and then that usually has a massive impact on our, how we feel and how we act, and our energy. And Kathy's actually picked this one, but the analogy I'm actually going to use is seesaw. So Kathy suggested garbage in, garbage out. But the analogy here is if we put shit into our zero file, then that's what we're going to get out. So we've got to be so careful with bookkeeping that we've got to make sure that when we look at bookkeeping, we don't just delegate it and have no responsibility after that point. We need to make sure we're delegating it to someone who knows what they're doing, they can do it well, and that the result you'll get or the information you'll get on the other side is actually half decent. Being pretty blatant here, and please don't anyone take a screenshot and send it to Xero. I'm not trying to say they're bad. We love them, but the point is if crap goes into it, crap's going to come out. And even as accountants, we can't really help a business owner before this stuff is clear to us. And we're looking at that windscreen wipers just spreading that stuff all over the windscreen.
And it's important to understand as well that in your team, in your business team, you might be a solo hero, or you might be a CEO with 50 people that work for you. At the end of the day, you need someone who's going to look after some of this stuff. So think of it as almost like its own department. If you're on a smaller scale, think as your bookkeeper, the contractor is part of your team. You want them to be working with you as closely as possible because it's critical. It is critical for you to be able to have that clear dashboard that you can make very, very important decisions on. And it allows the conversation to go to a higher level. I don't want to be talking to you about, what should I quote my coffee expense to or whatever. I want to be talking to you about how do we create more wealth for your family so you can go on holidays 6 weeks in a year. That's cool, right? So, but it starts here.
Absolutely. I'd even argue it's actually more important in a way than accounting.
Yeah.
Very strange. But anyway, alrighty. So we're going to cover the top 5 bookkeeping mistakes that we see. Now, Riz, did you want to kick us off with this one?
This is the one that we see quite a lot. It's easy. I can do it myself. It takes me 5 minutes. And then guess what? You're really good at your business. It starts growing and it starts getting out of control. And the very normal thing that happens is, I haven't had time. It's outstanding. I haven't looked at it. And what it stops is it stops you having this conversation. And that's the result of doing it yourself. So if you're a do-it-yourself bookkeeper, CEO as well, and you're managing the business at the same time, I'd say stop doing that. Find an expert who can do this for you accurately and at a good rate as well. The easiest kind of example I can give is I knew this doctor that did his own bookkeeping, and his hourly rate is something crazy, right? He's saving lives. That's what he does in his day-to-day business. Now, compared to kind of the bookkeeping stuff that he does, it makes so much sense when you compare just the hourly rate, the time that he spends on bookkeeping, not only the mistakes, but because he's not an expert on it, it takes way longer for him to do that. So from a cost perspective, he's already, if it's a $500 an hour charge out rate, he's already losing that money by doing that bookkeeping. Not to mention, you might be doing it on Sunday when you should be spending time with your family. You should be, hanging out with your friends and enjoying life. So this is stuff that is so readily available, the solution. So yeah, don't do it yourself. Mistake number 1.
Absolutely. Mistake number 2 is being irregular. Being irregular in general is not fun for anyone, but being irregular with your bookkeeping is just doing it whenever you feel, or whenever someone screams, "Hey, I need a BAS," or "Hey, we need to do tax planning," or "Hey, we need to submit your tax returns before the ATO comes after you." That's not what should prompt you to do your bookkeeping. We'll get it done, rather, because we're not doing it ourselves. Remember that. So a mistake we see is people just waiting for that next person to say, "Hey, I need this report," and then that's what triggers them. My recommendation is to have it scheduled in with your bookkeeper and do it regularly. Even so, weekly is like I would say that's the best practice. If you do it daily or get them to do it daily, that's even better. Bigger businesses will need to do it more frequently, but at least weekly for, let's say businesses turning up to maybe $2 million, $3 million in gross profit, let's say. That weekly I would find is acceptable for that sort of businesses. So
as well, one of the reasons why it's irregular is probably because you do it yourself as well.
Yeah, that's usually first two are quite common that go together. Cool. Yeah, just pay someone else to do it often and well, which is actually the next one.
Yeah, and that's it, right? Like if you look at this photo, that's exactly what it's saying is if you just do it yourself, how many times have I seen, everything's coded to general expenses? and yeah, it's a quick, easy way to kind of get your tax done or your BAS done. Yes, I've got the GST coding done, but it doesn't tell your story. It doesn't tell your business story. It doesn't tell the performance of that business for that month. So you're really getting this big picture of, I don't know what's happening in the business, but tick and flick, bookkeeping's done. So the part where getting it done is not good enough. Getting it done well, it's very, very important as well. And again, because if you do it yourself on a limited time, usually that's why it's not in detail. It's because you got to get it done. I only have an hour. I got to get it done. And it just becomes this.
Click.
Yeah, click. Oh, yep.
Reconcile.
And I'm being quite blunt here. I apologize, but I'm just really trying to make it very clear that bookkeeping is a critical function. Now, don't mistake that for control over your business. That's a different thing. Do not mistake that as if I don't do the bookkeeping, I don't know what's happening at all. Like they'll code it to the wrong places. That's a separate problem. That's something that we'll talk about when it comes to reviewing your numbers.
Yep, that's it. And the other one, just on the detail, is the other mistake we kind of see is if you've got 10 products or 3 different services, main services that you provide, but you've only got one sales line in Xero, it's going to be awfully hard to see what's really your moneymaker and tying up your sales on product A versus product B or service A or B, and the cost to deliver that. So even increasing the number of sales lines or sales accounts in your chart of accounts is actually a fantastic thing to do to be able to make decisions. And kind of go into this next one as well. This is a meme that's been floating around for probably 10 years or more, but it just kind of, I think the thing that goes along with that is you can always get it cheaper somewhere else, or something like that. Or the other one I've seen with this one is the clients change the budget halfway through the job. Kathy, you get what you pay for, all that sort of thing. So don't go with the cheapest bookkeeper. Don't go. We've seen there's some offshore bookkeepers we've seen do it well. A lot we haven't seen done well either. But if you're going the $10 an hour or $5 an hour VA doing your bookkeeping, you got to make sure they're actually doing it in a quality way. So just watch that out. And there's even onshore or Australian bookkeepers or firms that we've seen just do an absolutely shocking job, and they might be making some of these other mistakes, irregular, trying to rush it, things like that. So you just got to make sure it's quality.
Yeah, and no offense to anyone who kind of gets their mum and dad, to retired parents, to help them out with the bookkeeping. While it might be free or love equity, it is quality that you want to be looking for. Now, quality doesn't necessarily mean expensive too. Quality also means the conversations that you have with your bookkeeper. Now, you might have the same bookkeeper right now, but just to increase that quality, it might mean just working closer with them, because you want them to know what you want to see out of your bookkeeping, because they will do their best, obviously, to get to a point, but it doesn't necessarily you have to change bookkeepers. It's just maybe having a more upfront conversation, proactive conversation, setting out the objectives and a bit of rules around bookkeeping and when I want to see it and what do I want to see. That could increase quality itself while possibly keeping the price the same or a slight increase to it. So it doesn't relate. It doesn't necessarily mean quality means price. It's how you work with your bookkeeper. Remember, they're your team member. Look at it that way.
Yep, and just to wrap up the fifth of five, and kind of we're still on the same sort of path is that no review piece. So the other one we see is that we just assume that they've done it correctly, assume there's no need to actually have a review of what they've done, and so what we want to make sure is we're actually going in as business owners, we're going and having a look at the result, and numbers tell a story. So we need to have a look through what they've prepared and go, okay, cool. Well, yep, that all makes sense. Oh, hang on, this one looks about twice as much as what we've seen in the past. How is that the case? So you go in, see if there's a story that makes sense behind that. If not, it could just mean something's not in the right place, or where you paid 2 months instead of one worth in that field, let's say. So, I mean, yeah, the key here is that you do need to review what they've prepared and make sure it makes sense to you. Otherwise, you probably need to go and look into getting that fixed up. So, and the other thing that we do for our clients as well is we actually review we don't go into like a full-on financial control or for financial accounting review or management accounting review each BAS, but we actually do have a review of what the bookkeeper has done in each time we prepare a BAS for a client, and that's more of a GST review as well. So often we see overclaim GST on certain things. Maybe they're overseas, your suppliers, and we've seen an accidental GST claim there, but vice versa. Like sometimes if we don't enter in a car purchase properly, we miss claiming the GST up front on that thing. So there's definitely a review process that needs to be in place for bookkeeping.
Like when you review it, don't just review it for tax purposes. To maximize your deductions and get your GST claims, is review it for what makes the most sense for you and what your business should be, putting through the books. That's really, really important to understand that.
That's it, and that kind of wraps up our section on bookkeeping.
Yeah.
Sweet. Now let's switch over to cash flow, which is actually a bit of a monster section, but we're going to try to keep it sort of high level. Now, in our opinion, cash flow actually has a lot to do initially with pricing and your business model. So let's put ourselves in the position of, let's say, a builder, and there's a lot of builders in this position right now that aren't doing too well with the price of materials. But let's say you've got $1 million turnover. And you've built two or three houses in that $1 million of sales to a client, and a builder might make 10% on their sales. So you expect to walk away with $100,000 profit for that $1 million worth of sales. So that's a 10% net profit margin. So you've got 90% of your money goes to your cost of sales, your team and labor, things like that. So in terms of pricing, if you get that wrong, it can have a serious impact. For instance, I'll give you 2 examples here. Let's say you give a 10% discount to your customer just because they're nice or just because they're friends and family. So instead of paying $1 million in sales, you now receive 900 grand. But your costs don't change to deliver that. You've just gone from $100,000 profit to zero. So you've broken even. In fact, if you haven't taken a salary out yet, you've probably lost money. So it's not great. So please be careful about discounting. In fact, we never recommend anyone discounts at all because of the huge effect on your net profit. So you always got to look at what the effect on your net profit is before you do any sort of discounting. So do keep that in mind. And the other example of pricing a business model is, okay, you got that builder that sets their prices at $1 million for the 2 or 3 builds, whatever it is, expecting to have a 900 grand cost of that sale. But what's happened recently is the price of materials has gone through the roof. So that 900 grand cost might actually look like $1.2 million in cost. and you've got a fixed price contract to your client, so you can't change your $1 million sale, you've just lost $200,000. So we need to be really, really careful about pricing. And I give a pretty extreme example there. And you might be a service business, you might be a builder. I'm sure we've got a couple on here now. But I guess that the point is, yeah, you've got to make sure your pricing is solid. Otherwise, it might have a massive impact on your bottom line.
Yeah. And to kind of take away just quickly on that one, if there's anything that you need to take away from this is if you give discounts, stop. And if you haven't reviewed your pricing, the world's changing and has changed quite a bit in the last 12 months. And if your price was the same 12 months ago as it is today, you have not reviewed it, like, increase of costs and things like that, it means that your profit margin has depleted over time. So those two things, if you haven't reviewed your pricing and you're giving discounts, that's the stuff that you want to take away from this.
Awesome. Thanks, Kathy. That's great. Alrighty. So the second part of actually we've got three parts within cash flow. We've got the pricing, we've got cash flow days, which we'll talk about now. And then we've also got cash flow management, like literally of how you manage the physical dollars in the bank accounts. So the first example the first one we'll go through is cash flow days, just to show you the impact of where money might be tied up in your business. So it's surprising the amount of clients who say, oh, well, that's fine, Riz. I can see there's $300,000 of profit on paper, but where's all my cash? Where's it gone? Well, there's usually a couple of simple answers for that. Here's the most common. It's sitting in your offset account, or you've spent it personally, or you've bought an investment property with it, or it's tied up in, and here's where the business ones get interesting. It's tied up in stock. You've made 300 grand in profit, but you've just gone and stocked your shelves with $300,000 worth of inventory to sell. Or you've made the profit on paper, but the clients haven't actually paid you. That's horrible. So, this is critical, especially with businesses that have long payment terms with their clients. Sorry. So if you work with like huge businesses, like I've seen, let's say Target or mining companies like BHP, they take like 90 days to pay their frigging bills. So if you're a small business owner, you might have made the money, but you're going to take 3 months to receive it. It's crazy. We also see this a lot with manufacturers. And they've got lots of things to consider, not just how quickly they get paid, but they need to stock enough inventory to make stuff for their orders, get their orders out. Again, if their clients pay them in 30 to 60 days, you got to factor that in before you receive your actual profit. So, that's the kind of stuff we're going to go through, and we're going to get a little bit accountancy, but just to demonstrate how powerful this stuff can be.
Yeah. And just so we nailed that properly, that cash flow day stuff. If you ever ask that question, Riz, I've made the profit, but where's the money? The short answer is, or the first clue is, look at your balance sheet. And that's something that not a lot of people review, but that's where your cash has gone. That's the important thing: stock, inventory, accounts receivable, things like that, which we'll run through right now.
Yeah. So your profit and loss statement tells you how much money you've made. The balance sheet, as we said, just tells you where that cash has gone, so that you can't look at one without looking at the other. Well, you can, but it's not going to tell you much, missing bits of context. All right, so there's kind of three elements for cash flow days. The first one's debtor days. The second one is stock days, or if you're a service business, we call WIP days. And the last one is creditor days. So we're gonna look deeply at the debtor days and wrap it up with a bit of a like a case study, how all three intertwine. So debtor days is actually a calculation you do, and it's the average debtor balance you've got. And let's say it's throughout the year, divided by the annual turnover. And then we times that by 365 to get a day's, like a per day amount there. So in the example we give, the average debtor balance for this business is $50,000. We divide that by their turnover for the year of $500,000 or 500K, times that by 365. This might look like funny results here, but we try to pick round numbers. That means in terms of debtor days, this business is at 36.5 days. So that means in English, you take just over a month on average to get paid from your clients. That's kind of what that says. If a business has one debtor day, that's their debtor days. That means clients pay them within a day on average. So that's kind of where we're getting at with this stuff. And so let's say this business is 36 days. How do we unlock the cash here? So one day, if we break it down to every single day that we've got money outstanding for this business that turns over $500,000, that's an extra $1,370 that's not in our bank account. So if they go from 36 and a half days down to 10 days, we put, and so the difference there is 26 and a half, we put 36 grand back in the bank account. So we unlock the cash where it's tied up in debtor days. Cool. So just give me some thumbs up or some chat messages that makes sense, what we're doing there.
To bridge that as well, how do you get it from 36 days to 10 days?
Aha, good point.
Call them.
Follow them up.
The phone. Have someone on that. Like, you should be knowing what your numbers are. If you have this number in your business, which you do, if you're this type of business that has long terms, this is a number that you want to be like looking at, because 36 grand in your bank earlier means a lot more options and a lot less stress. Do you remember how the business value we talked about before? It all plays into that. So a lot more stress, less stress, a lot more happiness, a lot more options, and that means also you can reinvest that money fairly quickly as well. So you're churning it as quickly as possible. So that is a very important number if you're not getting paid on time. That's kind of the gist of it.
And just some quick wins. Take deposits from customers, follow them up if they're not paying within their terms. There's heaps of different things you can do to reduce debtor days. Receive payment up front before you start.
Get rid of the problem.
Yeah, you're not a bank. You just receive the money up front. And I know some people say, well, I can't do that in my industry, but can you? You sure? Can you take a deposit? If they're good customers, they like what you do, then maybe you might be able to change that conversation. So do please keep that in mind. The next one here is stock or WIP days. Now, this depends on what type of business you run. So stock is more for the retailers or the manufacturers, where they keep physical goods and stock. And then WIP is what we often refer to with professional services about, and we don't charge by the hour, but some people do. But that WIP, or the work in progress, the amount to yet be billed, is what we're talking about in WIP days.
And just to add on that, if you're a business that serves over a long period of time of project, you have WIP. It's just not on your balance sheet. You have to value that somewhere. It means that you're creating money that they will have to pay. So the other way to imagine it is, if I stop the work right now, can I bill for whatever I've done so far? WIP. Now, and that's an important number to know as well, because in your profit and loss balance sheet, yes, this doesn't look like there's money, but there's actually off balance sheet items right now that you've already committed to that has value in it.
Like most service businesses, a key indicator of if this is a problem or not is how often do you do your invoicing. So let's ask the electrician, how often do you do your invoicing? Oh, I do it once a month. You're going to have huge WIP days. You don't know it because it's time and you can't necessarily see it, but your WIP days are going to be, at least 30 days probably, because if you're only doing your invoicing that often. So maybe start invoicing every week or invoicing as soon as every job is finished. That's going to reduce your WIP days. Your WIP days, because it's going to turn it into debtors. So then you've got to chase up your debtors to keep that in line. So if we want to tweak all these things and make them better, this is kind of the things we need to think about. Now, stock days. This is a bit of an interesting thing. We're putting our hat on as a manufacturer or as a retailer. Let's use the example where you might have 90 days worth of stock. So you could keep selling your current inventory for 90 days before you run out. That might be what your minimum requirement is to have on the shelf, so to speak, but you're going to be carrying 3 months worth of the cost of that. So if you can start managing your inventory better and predicting what you'll need so that you don't need to carry as much stock, and you take 3 months worth of stock on the shelves down to 30, so you've got that month buffer, then that's going to put tons of cash in your bank account as a result of that. So that is a bit on this, on both the WIP and the stock element of this bit here. Alrighty. Now, the third part of cash flow days is actually to do with creditors, and this is how long it takes to pay your suppliers. Now, we don't want to take the piss here or upset anyone. That's not the point of what I'm trying to encourage here. But if you get 14-day terms for a supplier and you're paying them as soon as you receive the invoice, then I mean, you're actually doing them a pretty good favor. You're doing more than what they're asking for as well. So what I'm encouraging you to do is think every day you extend out your creditor days is more money in your bank account. Again, if we look at the formula for debtor days, and this is different for every business, so I'm just using the example, every day was worth $1,370 as a debtor. Let's imagine that's the same thing on the other side. So and you're paying it on day 0 instead of day 14 on average. So we got 14 days times by 1370. The result is 20 grand. So that's another 20 grand in our bank account by just paying within the terms right on the date it's due, but that's what they've asked for. So again, we're not looking to upset anyone, but just to illustrate the point. And we kind of see on the next slide, I've actually got all three, a case study or example of all three in motion. So we've got debtor days dropping from 36.5 down to 10 days. That put 36 and a bit grand in the pocket. Again, fictional business, but we've got 131.4 days, which is about 4 months, just over 4 months worth of stock on the shelves, or average WIP they carry. That's huge if it is a service business. If we get that down to a month, fictional business, that puts another 70 grand in the bank. And creditor days, we go from 14 and a half up to 30 days to pay the bills. Again, we're not trying to annoy anyone. That's putting 10 grand in the pocket. So total cash improvement as at today is 116 grand. So I thought you would, Steve. So I'm just keeping half an eye on the chat box, and some of the messages aren't visible to everyone, but so I might look distracted. But the total cash improvement. Now, we did this case study on a business that turns over $500,000, so $500,000. So that's more than 20% of the turnover that's now sitting in cash in the bank accounts. So it is important. It is so important that we get this right. Or constantly do things to improve this number and have an awareness of these numbers as well. So that is the end of the chat on cash flow days.
And I just want to use Ben's analogy of the electrician. I like that one because it linked a bit of few things here. So if they bill quicker, they drop their WIP days down. So think of the electrician. I'm billing them quicker, and then I'm collecting the money quicker, but I'm paying Haymans, my supplier. Sorry, Haymans, if you're watching, a little bit later because they gave me a 60-day account. What that means is all the cash that I've worked for and I've invoiced, I've collected, and I'm waiting to pay my bills. Isn't that a better position to be in than to be, hey, bills due, can you pay me? Can you pay me? I need to pay the bills. It's the other way around. I've got cash and I'm just chucking them out wherever it's required. So it's also important to understand if $116,000 in 60 days, you could commit to other projects that could make you more income as well. That's kind of the thing that helps you. Not saying that you don't pay your creditors with that money. Yes, you do, but you have more options at that time. So it's important to understand that when you combine all of this three together, you're bringing more cash in sitting with you, and you have the option, and that's less pressure and stress on your cash flow.
And just to bring it back to Riz's point before about all of this stuff is on the balance sheet. So we've just gone through three examples. We've gone through debtor days, WIP days, and creditor days. If we have a look at our profit and loss statement and we've made all these adjustments to put cash in the bank account, nothing will change on the profit and loss statement. All of these, this 116 grand in cash, all of that stuff you'll see on the balance sheet. So see how the two, I guess the focus for a lot of business owners is just on profit, but we need to keep an eye on cash and make sure that that's not, sitting on the shelves, sitting in our clients' bank accounts, or we're paying our creditors too early or before they actually need it. So.
And, when you have that clarity and you have the cash in hand, you're not stressed. Imagine what that opens up for you as a business owner. the headspace that you have. You're not in this rat race of just trying to make money, pay bills, make money, pay bills. You're elevated at a different level. So there is a lot of value. Now, if you do want to use this, if you're on zero, they actually have this as a dashboard that you can look at. However, be careful. You remember our analogy with CISO? Shit in, shit out. You just have to review that with your bookkeepers to make sure that that's in the right place. It's set up correctly. But it's already there. It's just something that you just need to be aware of. And that's kind of most of the point of today, is bringing it to your attention, and so that you can do stuff about it.
Awesome. All righty. Now we're going to change gears into physical cash flow management now. And the conversation we're going to have is around multiple accounts. I'm just launching a poll now. And you'll see that the question is, select all the bank accounts you have in your business. So it's multiple choice. So if you've got a working account, I think that's like everyone's kind of got to have a working account that they receive their money into and maybe pay some bills out of. If you've got a tax savings account, tick that box. Super savings, so that's for your quarterly superannuation bill. A rainy day fund, just a cash buffer. Some people might have a profit account. A buffer for your own salary, so you're keeping a special account set up that you're allocating to in case you need to rely on some money to put food on the table, or other. Please pop it in the chat box.
Cool. We might keep going then.
Yeah, yep. All right, so Steve, asset account, yep. You asset company maybe, eh? All right, Riz, did you want to run through this one here? I'll keep an eye on the
and yeah, the idea here is to have these different buckets of bags. You can see this in front of us right now. It's all down to what we call Parkinson's law. If anyone's heard of it, but the idea is that if you put something in a bucket, if it's just all in one main account, the in account, like we call it the revenue account, you tend to not know where the money belongs to, and you tend to spend it. You just use it, and at the end of the day, you go, I have a GST bill. I don't have the cash for it. Yeah, because guess what? It's sitting in stock. You've overspent that money because it belonged to the ATO. So that's another way of managing your cash flow. It's just making sure that you put things aside for the right places. Now, as the cash comes in, it belongs to many different people: your creditors, yourself, your pay, the ATO, and even your future, things like a profit or a rainy day account. That's something that you really need to consider if you have one account, and make sure that you contribute regularly. Make it a habit. It's a habit that you need to get into, and make sure it's consistently done at least every month, if not twice a month. Whenever that revenue account starts building up, you put it into the right places.
That's it. And so, Riz, I think we need to keep an eye on the time. It has disappeared. So I'm just sharing the poll results now. Everyone's got a working account, which is cool. Tax savings is the next most common, which is great to see. That's about 50% of people have a tax account. 33 have a profit account. Well done. A pro tip from Steve: chuck it on the mortgage offset account. That is a fantastic place for it. And then we've got a few people with super savings, rainy day, or buffer for your own salary. So thank you very much. Yeah, cool, Jade. And some banks offer multiple offset accounts as well. So you could have labels for them and even keep a fair bit of this business cash on your offset account. Cool. All right. Well, we need to keep moving. We have two subjects left. We've got planning and reporting. So a couple of tips here is, one thing that we need to do regularly is review your expenses. Stuff can sneak in there, and I even found a subscription. I signed up for a trial that hit the first month or two, and I forgot to cancel it. I saw that in my review of May's numbers yesterday. So yeah, we've got to do this stuff, go through every line by line, and the burner here is the recurring expenses. So make sure some of those recurring expenses, if you don't need them, are taken out of there. So that's kind of the quick version of that one. Now, the other thing we want to do is work out what your magic number is. That might sound a bit interesting, but your magic number, we need to be obsessing over it. And I'll tell you what it is made up of in.
Well, Ben's looking that out. with the previous slide about reviewing it, that's where I was mentioning at the start about control. This is where you get to still control the business if you have a bookkeeper. It is reviewing those numbers and making sure they're in the right place. So you don't want to be doing it, you just want to be reviewing it like a helicopter view of your business. So those are two separate problems I mentioned at the start, and that's how you solve it.
Yeah, yep. Sorry, I just posted in the slide didn't pull through for what I was actually going to show you, but the things in our magic number, I've just posted in the chat box. The things we want to build into our weekly magic number is our business expenses, our cost of goods sold, our wages as well. So the people we need to pay, your pay, profit target. So we need to build that in, and also if you've got debt, any debt repayments as well. So the whole goal here is we've got real clarity on and what our magic number is how much sales do we need each week so that all of this is paid. We know that we've got no stress around it. It's all paid. So once you know what it is, you need to obsess over it, build team KPIs around it, and report on it daily. And I really recommend that because it is critical. Like if you don't hit this, someone's not going to get paid. That is the end of the story. It's just factual. And a reminder, it only works if the magic number is accurate. Cool. Now, our last topic is all about reporting. Riz, did you want to run us through the suggested rhythms that we've got when it comes to reporting?
Yeah, so essentially what we recommend is to have a breakdown of quarterly, monthly, weekly, daily reporting. So quarterly, you want to start doing it on a high level. So you want to review the quarter on what's happened, and then you want to roll forward the next quarter. So basically having a plan or a budget at least for the next 3 months. You also want to keep track of your business value. If you're doing the right things, as we said before, that should be tracking up, or it could be going down if COVID happened and things like that. Because the idea here is that if you review those numbers at least quarterly, the ideas in your mind to improve the business value will kind of trickle down on the monthly and weekly reviews that you do as well. So at least quarterly. So you should be looking forward to that. So that should be something you book in your calendar. Every quarter, I sit down with my leadership team, my bookkeeper, or whoever that's responsible for this stuff, and look at these numbers. And then on a monthly level, at least review your profit and loss and balance sheet on a monthly level. So we're talking about management reports here. So we want to take away any tax adjustments that might shift the numbers a little bit. A lot of the default position is it's done for tax purposes. So what you want to do is start removing those adjustments, things like writing off, a $50,000 car. That's not necessarily the impact, the performance of the business. The idea is to look at how the business performed for that month. And you want to be reviewing that with your magic number that you set, whether or not you hit it, and what expenses do we under budget, over budget, and why didn't we hit the sales target, for instance. So yeah, that's important. And then on a weekly and daily, I might cover this together, is to review your magic number. To report your magic number. Essentially is to keep yourself and your team accountable and aware at all times. What is the one number that is required to make sure that all the bills get paid, you as a business owner gets your wage, the team members get their wage, and also there's a built-in profit. So if you work all that number, let's say it's 100,000, does your team know that your sales team knows that they need to hit $100,000 for that week? That's a pretty big business, but for that week, to make sure that everything gets paid. And then daily, you get them to report that. So you want the pulse of the business to be so close to everyone. It's on the forefront. And we even do like a big scoreboard where we actually look at that at our daily team huddle. So you want to obsess over this. Everyone should be talking about the magic number at all times. And if you do hit it, the best thing about it is celebrate it. Make sure you celebrate it as much as possible, because then that builds this culture around not just doing work, but bringing the firm or the business to the next level and celebrating that. Super important. If you don't have this, chuck it in your calendar and talk to your team about having the weekly and daily reporting as well, and having a dashboard of your magic number that you can run with your team. I'm just conscious of time there, Ben.
Yep. Yeah. Yep. So that kind of brings to the end our content, and I do want to say that if you do want some additional help with this stuff, there's a few ways that we can do that. The first one I mentioned earlier is Rose is actually going to post a link in for this expression of interest form, but we're actually running workshops in July. They'll be 3 hours long. I know we've just spent just over an hour this morning together, but we're going to go a bit more hands-on with your business, and there'll be workshops in Brisbane, Sydney if lockdowns permit, and also online. So we'll have an online option. Dates aren't in concrete yet, but if you are interested in this, then Rose has just posted that link into there, and if you can just fill that out, that'd be fantastic. Alternatively, there is another option if you do want one-to-one help, and there's quite a few clients who have taken us up on this so far, a little bit more aimed at clients rather than people who aren't yet working with us, but we've got one-to-one total, we call it total financial control implementation. So I'll just kind of walk through what the key parts are. So we actually help you build a 12-month business budget. We actually work out your weekly magic number, so that's sales target. We work out exactly what it needs to be, so you can go and share that with your team and make that like hugely front and center. And we also go through the old business cash flow cascade. So we work with you about what bank accounts will really help you manage your cash flow, and what the transfers need to be. Like literally transfer this every so often, this amount into that account. We actually walk that through with you. So do keep that in mind. And we do things like we also give you a business valuation estimate throughout that process as well. So, so if you do want to know more about that, then tick the box that says one-to-one TFC implementation, and we can have a conversation with you about that. So that's kind of it for the webinar. I do want to say if you do want to have just a general phone call with us, then you can book in for a strategy call with one of our accounting team. We are wrapping up our tax planning season at the moment, and we do have space for new clients joining us before 30 June if you'd like to get help with reducing your tax for this financial year. So please book in for a strategy call if you do want to do that. Other than that, we're here for the next 5-10 minutes for Q&A. So if you do have a question about what we've talked about today, then please pop it in the chat box or the Q&A box now, and we can run through it. So Jermaine's actually asked a question. So Jermaine's asked, for a high growth business, how do you take future business potential into account?
I think this is in relation to business value at the start then.
947. Yeah, good point. Okay, so if you don't have a comparative.
Yeah. So Jermaine, thanks for the question. Now, for high growth business, if you want to take future business potential into account, generally speaking, when this is generally, and depending on your industry, when the business value, you look at your business value, they look at kind of the last 3 years. It's historical, but there is weightage as well in terms of which year is more relevant. So let's say a pandemic hit, you're going to sell your business after the pandemic. The pandemic year, it's not going to be the year that you say, look, that's the normal year. You're probably going to weight it quite low. So you generally look at historical stuff and make adjustments accordingly. Now, if there is future business potential, usually that's something that you probably want to have some sort of explanation when it comes to the qualitative side of things, because there's forward and possibly forward projections as well. Now, it depends from industry to industry. There are generally accepted valuation methods that are totally different from what we just mentioned, and they might look at forward projections as well. But it all comes down to, with business valuations, it all comes down to kind of putting your best foot forward and playing that kind of game with anyone who's willing to buy if you want to increase your value. But at the end of the day, generally they look at historical, and the reason for that is just security for business owners to see things that have happened rather than will happen, which is quite a big risk. So they might look at that and go, yep, we'll put value to that, or hey, that's really, I'm not saying that it's not real, Jermaine. I'm just giving you a pragmatic approach of it. So it might be if you have a contract that's locked in and you can show them that, that's something that you can include in your valuation.
Yeah, tangible future cash flow. Yeah.
Mm.
All right. Thanks, Mark, for joining us. Yeah, good to meet you too, mate, over the chat. Thanks, mate. Thanks for everyone who's interacted. It's been quite good this morning.
Yeah.
Sometimes it can be a bit quiet.
Yeah. Feel free to keep chucking in those questions. Now, I did rush a little bit on the magic number side of things, but it is crucial. I just want to kind of touch on quickly on that one. It is crucial that if you're the only one that's responsible for your magic number, you want to think about spreading that across the team. No, not necessarily pulling down the pants of the business and showing everything. It's just one number that you want to work on. There's just one number that you want to work on with your team so that they're clear on what their KPIs and targets are. Now, it doesn't necessarily have to be sales as well. Now, remember that I said that you need to be aware of your debtor days and your stock days and all this stuff. That could be a magic number for a team member that's responsible for controlling stock or inventory or WIP, or the one that does invoicing or chasing or accounts receivable. So you could include other kind of non-sales magic number on your dashboard as well, because that is super important. Now, but the idea is it has to come from your numbers backwards. So if it doesn't come from your numbers, it's not going to make sense. It's not going to move the needle on your business value, which equals your happiness, your time, profit, and everything else. It's just going to be a KPI that they can tick the box and get a pay rise for. So you just have to make sure that it connects to the numbers, and that numbers connect to your business as well. So it's super important to understand that your weekly magic number is more than just sales and profit.
Yep, cool. So we've got a couple of questions. So Susan's asked, I run a small business that I'm winding up. When I start my new business, should I get Xero before I contact you guys for accounting? I'm not sure if I need to buy one, the subscription. Okay, so my recommendation there is if you're starting a new business, is to actually work out first what the best business structure for whatever you're looking to run is, because Xero, like every Xero account needs to match like an ABN or a business structure. And so you can't really set one up without knowing what structure it's being set up for. Business structure is so critical, not really the sort of webinar to go too deep in it, but your business structure determines how and how much tax you pay, and also asset protection. So that's kind of the recommendation there, is actually start with business structure, and the Xero works in with that. Cool. Steve, good old Steve. Actually, I've got both my favorite Steves on here.
I hope we don't have any other Steves then.
Yeah, let's not make them feel too jealous. But Steve's asked, how do you know how much should I draw out of? Okay. Read that slowly. Should I draw out of profit to pay myself? That is how much I pay myself and how much I leave in the business profit. That's sorry, Steve's heckling in the chat box that no one else can see. But that is a great question, and I guess that is so dependent on a number of things. So if you've got a business that is heavy when it comes, like heavy in its needs when it comes to cash flow, like you need money. So if you make 100 grand in profit, let's say, but of that 100 grand profit, there'll be clients who haven't paid you yet. There'll be stock that you need to go and restock the shelves with, and you know, who knows about your creditor terms there, but you do need to consider how much of that profit you need to keep aside just for cash flow, funding the cash flow, especially when it comes to growth, because growth costs money, and again, that's like an advanced thing on the whole debtor days and the stock days we've just spoken about. But that'd be one consideration. The other one is how much do you actually want to pull out of the business, and that really comes down to what your goals are, what you need to invest and build outside of your business in terms of wealth creation, and then, you know, what's your tangible return on if you do leave the money in the business. So if you do go and restock the shelves to fund your growth, are you going to get 20, 30, 40% back on that money, versus investing it in shares or managed funds at maybe 10 or 12% return? They're all the considerations. So it's not quite a blanket rule or percentage, as I've seen some recommendations in books and things like that. my perspective is it really comes down to what your goal is, what your business can do from a cash flow perspective as well.
And I like a staggered approach as well. You want to have a stock, take stock of where you're at right now with the business first, and work on the magic number in terms of what your profit is and what wages are you pulling out right now, and looking at where it's at. Now, you could start setting targets to work backwards. Say, look, I want to put X amount every month. What does that mean in your magic number? So if that increases to kind of a different number, that's kind of, if it's not achievable in the next 12 months, you want to have a quarterly target first, and you start building it towards that point. The idea is that it's not so much about how much should I pull out, it's how much I want to pull out, and I want to work towards that target itself. So that magic number is a clear way to make sure that whatever I pull out, everything else gets paid. Everything else gets paid, and that includes me and the amount that I want to pull out.
Awesome. All right. Oh, hang on. That's another open question. Joshua said, thank you. Appreciate that, mate. All righty. I think that is about it for the questions. And thanks for everyone who's hung around for a bit as well. I hope everyone had a good webinar, and looking forward to a great weekend.
Awesome.
But I think we might leave it there.
Yeah, thanks everyone for taking the time and spending some extra time with the Q&As as well. If you register, you will receive a number. And yeah, if you do need help, give us a call. We'll get in touch and have a chat about how we can help. But thanks everyone, and have a great Friday and weekend ahead.
Awesome.